Corning, I believe. Let me check that out. GLW on the New York Stock Exchange, Corning Inc. And I'm still fiddling around there with logarithmic versus just arithmetic. And I've always been doing arithmetic. It's a default on my TWS software. And you know, it's weird sometimes we get answers to our questions and then it's just clear cut, tuck, that's it. That's why I want arithmetic. And you move on, years pass by, and I believe the moment you forget why you took a decision and you can't answer truthfully, it's time to revisit that answer you take. Re-ask the question. And that's the best time to do it. And I just kept digging around and I Googled. I asked questions on stageanalysis.net. Then I found old posts from All-Star Charts there where they were covering that. And even on Peter Brandt factor trading website, I got there's some discussion about log and versus semi-log or not log or whatever. And I'm pretty much still, I think, arithmetic, but I'm still going to give just some more chance to the log or logarithmetic, and just see how it is. The advantage I saw about the log is my trend lines. It's easier to join up lines. Here, 1, 2, 3, 4, 5. This is right now you're seeing this is the log. The log, since its percentages, is the same distance for it's percentage wise. So from 20 to 21. Let's make it 20 to 22 is 10%. It's going to be the same distance as another 10% move there that we would have here. So for the stock here to have 100%, then it'd have to go from let's say 36 to 72, and that would be the same as going from 12 to 24. So you see, let's look at this line I did on the log scale. I'm just going to deactivate the log. And I'm going to do the inverse. It's always, it depends. It mostly depends on how exponential or how the growth is of the stock. If the stock has gone as, right now we're looking at the arithmetic, you see, 250 increments, always the same size. Let's say the stock goes like this on the arithmetic. Man, I have so much difficulty saying that. And then the stock goes like that. Then my trend lines, let's say I have 1 point here, 2 points here, and then I never get my third point to draw my valid San-Weinstein trend line. And then I have to relook at the new angle, and then I have one pot here, one unstop here. So I might never get that trend line. And since I don't get to draw that trend line as fast as I can, I don't have that protection to take half of my position off when it gets violated. I have to rely on my sell stops that are being moved up or a violation of the 30-week moving average. When I do it on the... Okay, let me put back the log. Logarithmic. Okay, so logarithmic scale. What would happen is, since it's a percentage-wise, the move, when you go up, it would actually bring down maybe some of these points here in a straighter line. And then I'd have I'd have my points. It kind of uncurves the real price. Since it's going up in percentage, it's... and you need more and more value on the price to get that, for you to be able to move up. Then you have a straighter line, a less exponential growth. And that permits you to have that trend line. So that's the advantage for that. Yeah. All right. So that's me thinking out loud and let my brain hear myself say it and process it, not just from the inside, but from an external voice. And that's very good. That's why I do the blogs. That's why I do the podcasts. The more you write down, the more you get to read. The more you, if you're lucky, you have people read what you write, and then they give you feedback on it. And that's how you grow. If you don't expose yourself and you don't challenge yourself mentally, you'll just spin circles in the wrong, not learning. All right, what do we have here for corning? Look at that, nice stage 2. Some violations of the 30-week moving average. So as a trader, you would have been out a few times. But it's all good because let's say you have a breakout. Let's just move back here. Look at that. Okay, here you had a nice breakout. Right here. Look at that. Okay, horizontal line above 30-week moving average, and I'm pretty sure we're going to have a candle for that candle here. I'm pretty sure we're going to have, there you go. See that volume right here? That one was highlighted. You could almost guess it. So now you had the, it's not twice as much as the average of the previous 4 or 5 weeks. But it's still good enough for an A plus to enter, or A. If you're not convinced and you'd have to wait, and split goes off, pulls back, move your sell stop right here. You only move the sell stop if the price action starts going back towards the previous high. And since it didn't go exactly back to the previous high, not a super duper move. And what happens is you get, here you had a valid trend line. 1, even 4. There we go. 1, 2, 3, 4, and you would have got triggered out right here. And this is on the log scale. Would I have had the same exit on the arithmetic scale? Let's put it out. Whoa, it's getting tight quarters here. 1, 2, 3. I would have had an exit, but slightly less aggressive. Or maybe here. 1, 2, 3. Yeah, you would have exited right here. So even see on this arithmetic or logarithmic, it didn't import too much. I don't know. Maybe it's a logarithmic is when you get more into a stratosphere, an exponential stratosphere, that it has more an impact on the trend line points or the lows, how far it brings them back down. All right, let's go back to logarithmic. And then you go, and that's what I was about to say, trend line violation or 30-week moving average. That means the price has moved sideways, and if it moves sideways, that means the 30-week moving average is starting to slow down. It means you might breach it, and it's just like a stage 3 or consolidation pattern. That's just like time wasted in the stock. So it's okay to be triggered out. You can always wait for this type of situation right here. Look at that crazy breakout candle on that continuation breakout. 30-week, above 30-week moving average, bouncing off it. RSI from midway point going upwards. That is just classic stance. So don't worry about it if you get triggered out. If you, the stage, it seems short, it didn't last as long as, well, you don't know how long the stage 2 is going to last. Right now it's lasting longer, and you always have potential for nice add-on patterns. And there you go. Off it goes. And sometimes I look at the RSI for the V's. Pull back. Price action goes back up. Move your sell stops here. Another place. Pull back. Price action goes back up. And did we have a valid trend line? 1, 2, 3. Yeah. So right now you would have triggered out this candle right here. And you would have reached pretty much close to the top of that stage 2. I got triggered out. Oh no. Well, it's not that bad, guys, because after that, you would have sold the remainder here on the violation of the 30-week moving average. And guess what? You're pretty close to a stage 3. And you could have risked even a stage 4 here. So move on to another breakout or breakdown. Beginning of stage 4 and 2s. That's what you're looking for. Ride the wave. And don't fight it. If the stock's starting to enter stage 1 or 3, do not fight. Do not try to stay in there. You'll just get whipsawed. It's just time to move on. It's not Stan Weinstein is for stage 2s and 4s. Stage 1 and 3s, they're there for you to get out. If you have other ways to make profits on a zigzagging sideways pattern, do it. But it's not the framework for that. All right, so what after that? We had a nice stage 3 breakout. Didn't really happen. Did it try here? It did have no. There's not really a breakout candle with a lot of volume. Even this one didn't have 3-4 weeks before. Kind of tight. I don't know how I would have played it here. Let's go back. Let's practice. See, even this candle didn't have a lot of volume right there. This one here, that's the breakout one. It didn't have 2 to 3 times the previous average. Then you could have waited. The other candles didn't have much volume either on the side. You weren't going over, well, yeah, a little bit. Midway point going upwards. You could have maybe tried it. But you want volume like this. Or even here it's kind of light, I guess. 2 to 3, yeah. Not A+. Like I said, not A+, maybe A. You could wait for another pattern and just wait maybe for a continuation pattern breakout if there's one. And that didn't pan out too well right there. We're back into stage 3 and stage 4 right here. All right, here's the thing with that stage 4. Let's look at that breakdown candle. I almost look always for the volume, honestly. Just by looking at the average volume here for 4 or 5 candles, and then you see a high wick. If it's red, then I'm pretty sure that there was a breakdown that happened at that level. And it's this candle, right? Which one is it? Yeah, it's this one right here. It's barely below 30-week moving average. And then there's the concept of the cloud. The cloud is the Ichimoku cloud. It's going to be its support or resistance projected in the future. So you kind of anticipate if you're a green cloud and you're above, you're in an uptrend, and that becomes support. And if you're under here, under the cloud, what's on top is resistance. So you would have had to go through this resistance, this support right here. There wasn't much. Would have been a gamble. You could have waited to go through, and after that, wait for a continuation candle, continuation breakdown to play that stage 4. And after that, here another stage 4 finished. 1, 2, 3, 4. Trendline violation. You're out. Because once it's not going aggressive enough, that means you're going sideways, chart's morphing to a stage 3, and then you go. You might have had another breakout here. You see, not a lot of volume on that breakout candle. You have a lot of support, a lot of resistance, that cloud. Not optimal to get in at this stage, just because you don't have the volume. Stan would not have really believed in that breakout at that moment. And maybe here, this one here, yeah, right here. This A+. You see that this is the volume we want. 4 weeks, look at that average. That's at least twice the average. Let's look at RSI. Do we have triple confirmation? RSI has, it's not crossing over, but it was already in a bullish, in a positive territory, going in higher. And there's no red cloud. We're above the red cloud, above the resistance. So this candle right here. This one right here. No, this one right here is your breakout candle. If you didn't trust the volume on these ones, this was it, and then off it goes up, pull back on the light volume, price action goes back up, move your sell stops. This would have been your entry, and your sell stop, you could have put it right under a 30-week moving average. For traders and investors, and if traders, you want to be more aggressive, then you have to find a spot under a round number, and ideally under a candle. And the best is just under the 30-week moving average. And what's happening here? Price action goes up, down, pull back up. Traders, investors. Oh, wait. How will that candle go? Low 22.23. And this candle is low 22.14. So you would have been okay. And like Stan says, you would have put your sell stop under that candle at 21.95. So you would have been even more safe. And right here, pull back, then move back up, move your sell stop. Investors, move it here. And price action goes up. Do we have a valid trend line? 1, 2, 3. Yeah, plus we have a valid trend line. Watch for a break. And there we go. 1, 2, 3. You would have sold right here this candle, half of your position. And if you would have entered again, you would have needed maybe a continuation move. Okay, this candle. Close maybe to the 2 to 3 to the twice as the previous 3 to 4 weeks average. And the RSI is going from midway points higher. So if you really want to play again, even if the stage 2 has been going on, you could have probably played here even after being triggered out because of that trend line. And what do we have here? Okay, pull back. Price action goes up. So your sell stop now is right here. And you get traded out. 30-week moving average, you're out. Investors and traders. So that was not the optimal move to do. And starting to move sideways. And off we go. All right, here we are today. And why am I looking at this right now? Because, and that's the danger when you start entering towards the end of a stage 2, but you don't know it's the end, right, until it's a stage 3. You enter the stage 3 whipsaw territory. Hold on, I'm just curious. How would have my lines? Could I have drawn a trend line right here? See, I had the trend line. One. Okay, this one's a mess. Move that. 1, 2, 3. This right now I'm back on the arithmetic log. 3, 4. Yeah. Okay, I would have exited pretty much at the same place. When I learn something new, I always have to compare. And for every scenario, try to compare. Okay, did that. And over time, then you could really have you can notice the differences between changing a single variable. And that's my process right now. That's what I'm going through. Right now, I have a top at 35. So that's why I'm setting my alert. All right, put it back here. And I have a breakdown at the 28 level that just happened this week. This is a valid breakdown. And you could have, it's a stage 4 right now. What's happening? Let me just check the volume. Could have even started a little earlier. Even these two candles had a lot of drop in volume. These are starting to break patterns within patterns, and then they accumulate until you get a good pattern that's really they're gonna be the driving one. That's why sometimes I see huge patterns and I just wait for a launch takeoff pattern that just consolidates right on that resistance, that breakdown line, and then you know you're ready to go for gold. And right now, here's this pattern, a lot of volume on these two candles. And then it's just starting to hit the support right here, previous support, and we're directly in the cloud, Ichimoku cloud, and just a little sideways action right there. And now we're below 3-week moving average. So the next breakdown from this consolidation pattern, I believe, will be the next leg into the real stage 4. I would wait for a close below here. Right below that support, the 27.25 level. Next week, maybe next week's candle. And remember, these are weekly candles, so any close on a weekly candle confirms the move or not for Stan. But you could always look at the, and you should look at the monthly candle chart. And let's just go take a look at that. Oh, what's that crazy? Okay, let's go zoom in. All right, here we are. And right now on the monthly candle, remove all trend lines, kind of messy. Here is the top formation on the monthly candle right there. Let me remove the clouds, clear that up. All right, here we go. There you go. That's better. So this is like my classical trade framework, monthly candles. I draw always my lines on the bodies, either the open or the close. All what's in the wick is just noise. It's it's weekly, daily closes that just the monthly candle refused to close at that level. It's a stronger prevailing trend. And even on the monthly right now, it's a breakdown. So the 30-week move average is starting to go down. I have my top pattern confirmed. It's not confirmed, sorry. Next week it will be. So next week, at the end of the week, if the price action doesn't suck back in and close above, if it doesn't close above 28.81, we have a breakdown even on the monthly candle. I could even play this on my classical charting ways framework, my simple framework, and here would have been the implied measure move. But what's fun about Stan is that stage 4, if it surpasses that initial measured move from that top formation, I could write it all the way down, no matter where it is. And that's what we want to try to leverage in using Stan's system. Corning, man, you look like a short for me. I'm going to wait till the end of next week, and this is a strong candidate for stage 4. Hopefully, the price action gets dropped a little bit down below that support right here, and we'll be ready to go to roll to play that on the roll down the hill. All right, Corning, stage 4. See you next week. All right. Ciao.